High-yielding dividend stocks is something that I've been straying away from over the last 6 months of my investing journey. With that said though, if a company's stock has fallen, allowing that dividend yield to be higher, I'm all on board. And there's a misconception amongst the dividend investing community that dividends are free money. Dividends are not free money, guys. So today, I'm going to be sharing 3 quality businesses that have been discounted recently, allowing them to have a higher dividend yield than usual. And if you guys appreciate this type of content, I promote real man's investing on this channel, not buying stocks based off of fear or hype. It would mean a lot if you hit that subscribe button for me. And of course, roll the intro.
Hello, I like money.
Alright, the first company we're going to of course go over today is Vici, stock ticker VICI. Vici owns properties along the world, mainly in North America and mainly in Las Vegas to be more specific. They own a lot of properties across the Las Vegas Strip, which is one of the most iconic and the most popular vacation destination in the world today. These properties have elite locations that simply cannot be replicated. This is why I think Vici is so appealing to so many more growth investors. Vici is collecting 100% of rent, but with that said though, Vici stock has fallen due to higher interest rates. Vici has also been making acquisitions left and right recently, which has had them accumulating more debt, which has some investors concerned, especially with the higher interest rates as I mentioned. But if you're a long-term investor, right now could be a great time to scoop up some Vici. Right now they're trading at a stock price of $27.51 per share with a dividend yield over 6% right now, which historically for them is pretty high. Intrinsically speaking, I think Vici is one of the most quality REITs you can buy today. Compared to Realty Income, I think they have a lot more growth ahead of them. A big thing to keep in mind with Vici is that they don't actually benefit of the performance of the casino operators themselves, whether that be negative or positive. So even if these casino operators have a bad month when it comes to people and degenerates going to their casinos and gambling, Vici is not affected in one way or the other. They are collecting and raising rent month after month, allowing you as a shareholder to take place in that cold hard cash transaction month over month. It's really a simple business model to understand, which is why I love it so much. I made a Vici stock review video last year and I'd highly recommend you check it out for a more in-depth look at Vici's business and financials itself. Their CEO, Ed Pitoniak, is a certified G amongst the investing community and is known to go on YouTube channels. If you guys want to see Ed Pitoniak on the channel, smash that like button. If we get 100 likes on the video, I will send an email to him. Something that you see commonly amongst REITs that we don't ideally want to see with our companies is share dilution, and with Vici, share dilution has been a big talking point over the last couple months. A big reason for the recent hike in share dilution is because of all the acquisitions and the diversification that they're making in their business. Long term, this will pay off for sure, but this is scaring short term and medium term shareholders, especially with the higher interest rate environment. I would not pay too much deep attention into this. And let's move on to the focal point of Vici, which is of course the dividend payment. Now with REITs, you're not going to be seeing crazy dividend growth, but with Vici, you're actually seeing some very quality dividend growth. REITs are technically have to pay 90% of their net income in the form of dividends, and Vici has only been public since 2017, so there's no long-term history of dividend payments and growth, but I would not expect 8 to 10% annual dividend growth from Vici. I would expect maybe 4 to 6%. With that said, Vici has been paying a dividend since 2017, and they have a 1-year growth rate of 15.28%, a 3-year growth rate of 11.67%, and a 5-year dividend growth rate of 9.55%. For a REIT, that's exceptional dividend growth, but as I mentioned, I would not expect anything along those lines long term. They recently hiked their dividend, which was 6.41%, which is a very solid hike regardless. It's below typically what they do, but another thing you need to keep in mind here is the recent acquisitions they've done. They're not going to hike their dividend 12% if they just took on a lot of money in debt. Now let's take a look at the payout ratio to see how sustainable that Vici dividend is right now. Now, as I mentioned with the net income, they legally have to pay out 90% of their earnings in the form of dividends, and I'm not a huge fan of looking at net income when it comes to the dividend payout ratio simply due to accounting reasons. I like to look at the free cash flow payout ratio, and right now Vici's free cash flow payout ratio is very solid, sitting at 62.79%. For a REIT, that's very quality, and for a company overall, that's pretty solid. Vici has also been growing their FFO per share, which is the funds from operation, which is basically what you want to look for when it comes to like a REIT's financials. Typically, you want to look at free cash flow for a company's health, but for REITs, you look at price to FFO per share. So with Vici, right now might be a solid time to lock in a solid 6% dividend yield on cost and acquire some Vici shares for the long term. In the short to medium term, Vici could go through some more struggles, but I do think they're being priced at a pretty hefty discount right now. Alright, the next company is one that I've been known to talk a little bit about in this channel, which is of course Starbucks, stock ticker SBUX. Right now, Starbucks is trading at $94.19 per share, and it's trading at a dividend yield of 2.42%, which for Starbucks is historically high. Starbucks is a business and a restaurant that I'm really awed at how their growth has been and how their business model really works. Whether it be how they secretly act as a bank, their rewards app, or how they're using automation to their advantage, Starbucks is doing an amazing job right now when it comes to the business side of things. I'm just saying, every time that I go to Starbucks, it's packed. They have amazing locations around the world, more noticeably the North American and Chinese markets are the more rapidly growing ones, more specifically China. If they can get China growth to be more consistent, their free cash flow will be a result of that. Over the last couple of years, China's been closed due to the C-19 virus, and that's kind of had an impact on Starbucks' financials when it comes to the consistency. Not to mention, Starbucks has pricing power as well. People are quite frankly addicted to their products, and I can speak from experience. Starbucks has pricing power on all their items, and people are willing to pay $6 or $7 for a simple drink. I don't know how people will pay for the food, but that's besides the fact. Starbucks has an unfair competitive advantage with the rewards app. Basically, every time somebody uses the rewards app or signs up for a membership on that and they load money onto the app, Starbucks can take that money interest free, which saves them millions of dollars every year to make new investments and grow their business faster than other coffee chains. They got a leap on this 2 years ahead of Dunkin' and other restaurants when it comes to the coffee side of things, and they're able to grow their business at a rapid rate compared to them. This gives Starbucks a huge competitive advantage over Dunkin' or other small coffee businesses and chains. As of recently, Starbucks has been trading on a bit of a dip and has even gone below $90 per share. Now, dividends are the result of a company's business execution and mainly the free cash flow, and for Starbucks' free cash flow, it's not the optimal thing that we'd love to see. Now, obviously, the big reason of this is because of China and C-19 in 2020 that has kind of messed things up when it comes to the consistency side of things. But over the next 5-6 years, I believe Starbucks will start consistently growing their free cash flow, and that's going to be a huge thing for the company. If they can stay open in China, I think that'll be great for them. They have a 5-year free cash flow growth rate of 3.73% and a 10-year free cash flow growth of 14.48%. As I mentioned, though, we're going to see for a few years how that kind of averages out as China stays open. But I would expect it to be much better than what it looks like right now and more consistent, more importantly. Alright, Starbucks has been a very shareholder-friendly company when it comes to buybacks and dividends. They have a very strong share repurchase program, and I'm hoping next quarterly report on November 2nd, which happens to be my birthday, so smash the like button for me because of my birthday. But I'm curious, and I'm hoping that they repurchase some shares at these lower prices. Starbucks' dividend, though, has been very strongly growing over the last 10 years. They have a 3-year growth rate of 11.61%, a 5-year growth rate of 9.63%, and a 10-year dividend growth rate of 18.43%. They had a recent dividend hike of 7.55% and have recently been hiking it in the 7 to 10% range. As a shareholder during these kind of economic conditions, I'm very happy with that. But how sustainable are these dividend hikes? I think it's also important to mention too that they even hiked their dividend during C-19 in 2020, showing the strength of their business and how they operate. Based off of net income, which is a metric that I earlier ironically said that I don't love looking at for payout ratio, they have a 69% payout ratio. But when it comes to the free cash flow payout ratio, right now it's 88.55%, which is not ideal with you want to see in Starbucks. With that said, though, with the recent hike of 7.55%, I do believe that management believes that this payout ratio when it comes to the free cash flow side of things will go down and that the China impact will really benefit their free cash flow in the next couple of years. If you do your research, I'm really not that concerned right now. At the end of the day, Starbucks isn't some crazy high-yield dividend stock like Altria, but it historically is trading pretty high. So Starbucks is going to be a business that I'm continuing watching over the next couple months. And we're going to be staying on the theme of restaurants because the next company is, of course, Mickey D's, McDonald's. Now, I just made a McDonald's stock analysis video, and I'd highly recommend and I'd highly appreciate you check it out after this video. I'll leave a link in the description or in the top right corner right now, but it's a very well done video and it goes pretty in deep when it comes to McDonald's financials. Right now, McDonald's is trading a McPrice of $258 per share. They traded pretty much near a 52-week high, or an all-time high as a matter of fact, near $300 per share, but since then it's fallen down to the 250s and even hit the 240s. With that said, though, as I go over in the video, I think McDonald's is a good buy in the $230 to $220 range, not financial advice for me personally. McDonald's has a McDividend yield of 2.59% and pay out $6.68 per McDividend. Taking a look at McDonald's McFree cash flow, they've had very solid growth and very consistent growth. Nothing crazy, but just what you want to see ideally from a company like McDonald's with very solid growth in the last few years. Watch the stock analysis video to find out why. They have a 5-year growth rate on the free cash flow of 10.22% and a 10-year growth rate of 6.75%. Assuming this continues, McDonald's should have no problem paying that McDividend. McDonald's has had some very quality dividend growth with a recent increase last month of 9.87% and recent hikes being near 10%, which is really good for a company like McDonald's and the size that they're at. They have a 3-year growth rate of 9%, a 5-year dividend growth rate of 10.58%, and a 10-year dividend growth rate of 7.5%. It's nothing crazy, but it's consistent, it's stable, and it's sustainable, which is what you want to see. At the end of the day, McDonald's isn't going to have some crazy growth, but they have had some pretty quality growth in the last couple of years due to some investments and some business strategies that I talk about in the video. Again, I highly recommend you check it out if you're interested in McDonald's stock. I want to thank you for making it to the video. Let me know which of these 3 stocks that you're buying or looking to pick up. I get it, I didn't share any 5, 6, or 7% dividend yield stocks except Vici. In my opinion, I view dividend yield really as just a result of the stock's price. I don't like companies historically trade at like 7 or 8% dividend yields, especially if the financials can't back it up. I appreciate it. If you haven't already, check out the channel memberships, link in the description for a bunch of awesome perks. Smash the like button, subscribe, and of course, do dividend stocks on drugs. Have a good one.